let's go back to the beginning. So 2008 was a period, in fact, I'm going to go back to 2000. 2000, we started to see the debt bubble increase and the rise of central banks. So Alan Greenspan back in 87 was the first one to start using interest rates really to stabilize markets. That became modus operandi by 1998 when long-term capital blew up. The Fed did it again under Greenspan. Then 2000 we had the stock market crash and the recession. And again, interest rates were used heavily. Now, the money illusion meant that lower interest rates, people thought, I'm going to take on more debt. So they took on more and more debt. And that led to the housing bubble, as we know. And then that blew up and almost brought down the world's financial system. Now, I was in Spain at the time. I'd left the hedge fund industry, but I was still writing, as I do today, Global Macro Investor. And I realized that the fragility of the system was now becoming the most urgent thing, and that after 2008, we hadn't really solved it. In fact, it was bloody clear by the time we got into the European crisis in 2012 that it was not solved at all, and debt was the big issue. And the only answer at this stage became the printing of money, because there was no other way to deal with it. It had become too big, too gigantic, too scary, too dangerous for anybody to let the fire burn. The whole Austrian economic idea of creative destruction was now almost impossible for anybody to let the fire burn. The whole Austrian economic idea of creative destruction was now almost impossible to implement because the destruction would have been total and complete. And many people think, well, the bankers could have gone under. Maybe we should have let everything clear. Well, at this point, with this many old people as baby boomers into their retirement ages, you would have wiped out everybody's savings and investments too. And that is okay if you're starting from nothing. But anybody who'd started with anything would have been entirely destroyed. Now, this story shouldn't be a surprise to you because it is the story of Japan. We saw this in Japan, where the Japanese realized that their aging population and their saving assets could not be destroyed. So the only thing to do was try and manage crisis via the role of the central bank and the merging with government policy and fiscal policy. And Japan has been basically the petri dish for all of this. And almost everything Japan has done has happened elsewhere in the world. But after 2012, I wanted to make sure that there was a way out. Now, that was the first time I wrote an article. I think it was back 2013. I wrote an article called The Life Raft, where I talked about gold and, in fact, Bitcoin. I had started to have Bitcoin on my radar screen as some good friends of mine, some Global Macro Investor members, had been involved in the early days. I was going to set up the world's safest bank. That was the idea. A bank that only held US treasuries, and that any money on deposit was entirely matched by treasuries that were held at the Fed. No rehypothecation, no nothing. So it was kind of a bank outside the banking system. I had that idea, but it was bloody hard to set up a bank. You know, people like Caitlin Long, I'm good on you. It's really hard to do. So I was running around the world looking at this idea, and the Bitcoin idea came to me from Emil Woods. And Emil said to me, listen, this might be your answer. And I had seen it and looked at it, and it was very interesting. In 2013, I bought it. It went up 100% in a month, and I sold it. I was like, wow, okay, what was that? I wrote an article in 2013 or 14 about the stock to flow of Bitcoin, looking at it versus gold, and saying with gold at about $1,300, where it was at the time, I would impute roughly, without the great maths that my friend Plan B has managed to do, but I had a rough rule of thumb that Bitcoin was probably worth $1 million in comparable terms, using stock to flow, you know, how much gold was underground, how much gold was being mined, etc., and back imputing it into the Bitcoin price. And that gave us a macro framework, and that macro framework became quite well known at the time and got passed around and got many people into the space, actually. Then I was out of the space for a while and then got back in around 2015, 16. And I started buying again, probably around 200. And I think I sold out early when the forks were happening. That was the FUD of the day. We'd had scandals all the way through S-curve moments within Bitcoin. And that moment in time, I didn't understand the ecosystem. I didn't understand the adoption effects of Metcalfe's law, and it was much earlier. So I thought this was an existential crisis when you're forking something. What did it mean? I didn't really know. I wasn't comfortable, and I'd made 10 times my money. It was at 2,000 at that point. So I took profits, and obviously it then went up another 10x, and I felt like an idiot. I didn't have money in the bank, but I didn't make as much money as I could have done, should have done. I didn't have a massive allocation. I had a deep, reasonable size, but not life-changing amounts. But it taught me a lot about the cycle. I pretty much saw the top of the market, and then it came down. And, I still believed in what Bitcoin was, but I didn't think I had a time and a place right now. And I thought that was important because macro does matter to Bitcoin, doesn't exist in a vacuum. And so it was off my radar screen. And, I was looking at most macro opportunities. So we're talking about 18, 19. So 18, 19, we saw some interesting opportunities in the bond market because I thought that the global business cycle was slowing down and we had one last shot at the rate trade. The heroic trade of loading up on Eurodollar futures as the Fed had to cut and offset the rising in rates that they'd done, and that the bond market was going to start pricing in deflation again as my economic indicators started forward-looking, predicting a recession. That came, as we know, in March. But in March, we go back a bit, I had always said that crypto, and Bitcoin in particular, and macro were the same thing. They just didn't know it yet. And most participants didn't know it and didn't understand it. Crypto came from a different community. It came from a community of developers, the kind of cypherpunks. It came from Austrian economic school kind of philosophy. It came from libertarian philosophy. It came from a number of different things, but it started to attract the attention of finance people, particularly the macro guys like myself. Our job is to find assets that best represent our views and where we are in the world. And we are all, without question, troubled by the debt supercycle and how this all plays out. So when we saw Bitcoin, one by one, people moved across. Famously, Dan Morehead was first. And then a lot of people, whether it was John Burbank, Mark Yusko, whether it was Dan Tapiero, whether it was myself, Mike Novogratz, bit by bit, everybody from the macro world, Stan Druckenmiller, Paul Tudor-Jones, Alan Howard, you name it, they're all moving across because they've seen the magnitude of the opportunity, because we all knew that they weren't parallel paths, they were convergent paths. And they all converged last March. So that's when I got really excited when Bitcoin collapsed in the big liquidation. It had been building this beautiful chart pattern, that beautiful, massive, gigantic wedge I called the best chart pattern in the world. And a break of 10,000 was going to be the confirmation. And I loaded up with every single penny that I had available. And so I put it all in to Bitcoin and it broke out. Because what was going on was we were now going into the biggest recession, maybe in all recorded history. So as you remember, my thesis was liquidation phase, which was into March. Then I closed out all my shorts. Then it was going to be the hope phase. And then it was going to be the kind of insolvency phase. So the hope phase happened. And that was built on vaccines and things are going to be okay and herd immunity and all the narratives that happened. But something different happened as well. Interesting enough, the real-time economies never really picked up for a while. They did exactly kind of as expected, but the markets didn't. The markets did the opposite. I said we'd probably finish the year at kind of -3 to -5% year-on-year GDP growth, and that's exactly where we got to. So the hope was misplaced because the economy was shit, and people had been laid off, and the structural unemployment. And many of the people in retail, for example, are never going back to jobs again. So there was a real structural problem. The insolvency phase should have been that the triple B entities, the giant corporates, should have run out of cash because they didn't have enough cash flow to paper over the debt payments that it needs to make. So it becomes harder and harder. Their equity price falls and it all becomes more difficult. But that was also going to happen at household level, where households were, yes, some people were furloughed, some people were given payments, but eventually the payments stopped. And if they didn't have jobs, the musical chairs stopped and you're kind of screwed. And the same with small businesses. So we saw immediately the government do something it's never done before, which was instant transfer payments, which was a stunning move towards a more MMT-style environment where fiscal policy and monetary policy are roughly the same thing, or they work hand in hand, which is what we've seen in Japan over the years. That was amazing. It helped a lot of people and basically delayed the insolvency phase. Technically, many firms, many people, many businesses are insolvent, but they're kind of being kept alive by the central banks and the governments. And still to this day, we're still in that same cycle. It's become apparent, and I talked about it in the past, is governments and central banks have to do absolutely everything to avoid the insolvency phase. My guess was they were unlikely to resolve it all, and I think it actually plays out longer, and it is actually in reality in play, but we're not going to know until we try and revert back to some sort of normality. This is one of the key reasons why the central banks simply cannot allow rates to go up, because you will destroy any chance of recovery. So anything, if the market wants to go there and try and price in higher rates, yield curve control is going to kick in. We've got pseudo yield curve control in Europe, and we've got yield curve control in Australia, we've got it in Japan, and I think it would come in the US. And that means that rates can't actually price inflation. Now, I'm not an inflationist. I think we will get cyclical inflation because of the supply constraints and the massive rise of people coming back into the labor force and back in economic life. But as we settle down, I think the debt deflation narrative, technology, globalization, aging population, all of this stuff continues to weigh on inflation. And over time, as the economy settles to trend rate of growth, potentially inflation falls.
It seems like we've gone from having to answer economic questions to having to answer political questions, because so much of the economy is now tied to government spending. And so I think a lot of my viewers assume that we're just going to get limitless stimmy checks and universal basic income, and Biden is just going to go from a $1.9 trillion package to a 3 trillion to a 5 trillion to a 10 trillion to a 20 trillion. It's never going to end. But you have a little bit different view. You think he's going to get some gridlock there, and that's not going to be a reality. Can you explain that a little further?
Well, he has, his hold over the House and the Senate just is very narrow. He's 50-50 in the Senate. That means he needs Senator Joe Manchin to go along with whatever he does, and Manchin is more of a moderate Democrat. And then he has a five member lead in the House of Representatives, so he needs to get almost every Democrat on board. But even a greater question is, how much more debt can the bond market tolerate? We do have some, the construct of the economy in the United States is artificial. It's all artificially engendered. I mean, if we actually had a real economy, what do you think the cost of money would be if the Fed were to announce tomorrow? In fact, the Fed has a meeting today. This is being recorded on Wednesday. If the 2:00 press release said the Federal Reserve is now no longer expanding its balance sheet to zero and market rates will prevail, what do you think would happen? I mean, what do you think would happen to the stock market? What do you think would happen to the real estate market? So it would be an absolute depression like we've never seen before. So everything is artificial. And like I said before, we had $6 trillion in borrowing that was almost all monetized by the Federal Reserve in the last year. That's completely artificial. So when that ends, I assume that the bond market will at some point no longer tolerate deficits and debt. We know, what do you have? $28 trillion national debt right now. Total debt in the United States is 400%. 400% of GDP. That's an all-time record high. It's a little bit higher than it was at the nadir of the Great Recession in early 2009, like 2008, early 2009. So how much more debt can we withstand, especially in the context of the fact that the Fed will announce its tapering, in my opinion, probably later this summer.
Why do you think they'll do that? That's definitely contrarian.
So I said they'll announce the tapering. They will say, I believe the next few non-farm payroll reports will be blockbuster reports. Over 1 million jobs in the leisure and hospitality sector. Now, the good news there, of course, people getting back to work, but those are very low wage jobs. So that will bring down the unemployment rate, but the employment cost index will also not get out of control because they're traditionally low wage jobs. You're not hiring, people and lawyers and doctors and so much on Wall Street. You're hiring people who are food service workers, and they tend to be lower wages. So you'll bring down the employment cost index a little bit. Labor wages won't go out of control, but they will be higher, but not out of control. But when you say, Mr. Powell says he wants to see significant progress towards rehiring all those people that got laid off during the pandemic. Well, a lot of that is going to be past us by the fall. And I think instead of actually raising interest rates, which is probably not going to happen, I don't think it happens. In fact, I'll go out on a limb and say, I don't think Mr. Powell will raise rates at all this cycle. I think he's going to stay at zero until we have our next recession. Okay? He said, you look at the FOMC dot plot, there really isn't a rate hike until 2024. I think we have a very big problem in this country, a deflationary problem in this country before then. So he's going to stay at zero, but he will announce the taper because there will be substantial progress towards meeting his goals of rehiring and bringing down the unemployment rate. The taper will probably start next year, 2022, and end by the end of the year.
When you say taper, you mean he'll reduce the 120 billion that he's buying right now, or he'll start selling?
No, the Fed will never sell a bond in its life. The Fed will reduce the expansion, the rate of increase in its expansion. So probably do 10 billion a month. So it'll take a year to get down to zero. And then he'll just either keep the balance sheet and have a period of stasis for a while, or he will let it run off. In other words, when a bond matures, he won't go and buy another one in the open market. So that's how he will unwind his balance sheet. So the idea of the Fed actually selling bonds, and when you're running an annual deficit of trillions and trillions of dollars, which is over 15% of GDP, the idea of the Fed adding to that by selling bonds, which is more debt that the free market economy has to absorb, is out of the question. They'll never do it. They will let those assets roll off the balance sheet. That's what I'm predicting.
So if that happens, what do you think the long end of the yield curve does? Do you think it immediately spikes and therefore the stock market crashes?
So I look at it this way. I think short-term rates will rise on the announcement, and we'll have another taper tantrum where rates rise across the yield curve temporarily, very temporarily. And then I think we enter into a period of disinflation, which would bring down long-term rates lower, bring them lower. So it will be just a temporary spike as they say, oh my gosh, the free market now has to take control of the bond market, and that's going to be disastrous in the short term. But then we realize, hey, wait a second, what does the real estate market and stock market do when interest rates spike? Well, they'll collapse, which will bring rates down.
Okay, so if our economy is built on asset bubbles, and I think the main asset bubble being the stock market, if that goes down by 20, 30, 40, 50%, that's going to crush the purchasing power of the average baby boomer, where the majority of the wealth is concentrated, and therefore nominal GDP's got to take a hit. So how far down do you think the Fed or the central planners can allow the stock market to go before they step in, reverse course, and takes just more extreme measures.
Yeah. So I thought about that a lot, and I think that the number comes to my head about 30%. I think if the stock market went down 10 to 15%, maybe even perhaps 20%, the Fed might enjoy that because, Mr. Powell is feckless, but he's not an idiot. Okay, he's not completely inane. He understands that we're in a bubble in the stock market. He can't avow, he can't admit to that on a press conference, but he understands that prices in real estate and in equities have to come down. It would be healthy for the economy. So I don't think he would panic for a move that was 15 to 20%. But if the move lower on the S&P 500 goes to 30%, that would be enough to freeze up all of the credit markets. So all of the short-term money markets would freeze, repo markets would freeze, junk bond market issuance would freeze, and that would be enough to get him off the sidelines. The question I have is, if this occurs in 2022, which is my prediction that it will occur in 2022, probably in the teeth of the taper, sometime in that time frame, especially if we don't get $6 trillion of new stimulus coming from the government that has to be monetized by the central bank. Then you're going to get this period of deflation. So disinflation will morph into deflation. And then the question is, and here's the salient question: if Powell says we're going back into QE and we're buying junk bonds in a big way, does the long end of the bond market respond positively? In other words, do prices go higher and yields come down, as they always have done since 1987? Every time the Fed has gotten involved in markets, it's because of a deflationary crisis where asset prices fall, right? Correct? So they are trying to reflate asset bubbles and reliquefy credit markets. If that has been what's been inculcated to investors' minds, Fed comes in, they have the massive QE program, lower interest rates, and the recession begins to be turned around. It's ameliorated, mollified, and then we start heading higher.
Right.
But if Powell does it in 2022, he will have zero room to lower interest rates. Let's just start there. It normally takes 500 basis points or more of interest rate reductions to re-stimulate the economy and to reinflate asset prices. He'll have no room at that point. And he will also be in some form of QE. It may not be 120 billion a month. It may be 60 billion a month at that time. So, at the height of the Great Recession in 2008, QE was 85 billion a month. It's now 120 billion. If he's already at some capacity of say 60 billion a month, going from 60 billion to 100 billion a month, is that enough to reinflate asset prices when he has no room to lower interest rates? And even if that's successful, does the bond market remain quiescent? In other words, think about this, George. In 2008, we were all told by Ben Bernanke that this was a one-time emergency measure that the Fed would have to undertake. We would expand the balance sheet, we would lower interest rates. Once the housing market healed, we would never have to do this again. This was a once-in-a-100-year storm. Well, that wasn't really true, right? I mean, you remember, and you talked about it in the pre-interview, the repo market completely froze in the summer of 2019. The Fed was already in QE, back into QE in 2019, and had lowered interest rates 3 times by the end of that year. This was before the pandemic broke out. So the economy doesn't function. The asset bubbles and the artificial nature of these asset bubbles and the economy cannot exist unless interest rates are extremely low, practically zero. And you have a constant infusion of new monetary fuel. So now that Wall Street knows, hey, listen, I believe you could get away, Federal Reserve. I believe you can get away with all this monetary inflation and deficit spending because deflation was our primary problem. What if they do it the next time and the Fed comes back in a huge way with QE, even bigger than before, adopt some form of universal basic income, And the bond market says, wait a second, I understand what's going on here. You will never be able to stop QE. You will never be able to raise interest rates. And that starts to affect the sovereign bond market here in the United States, which sends yields much higher. That's a risk. That's not a prediction. That's a salient risk. And if that happens, you will not stem the tide of a 30% reduction in equity prices. You'll have bond prices crater at the same time stock prices crater. At the same time, real estate craters, because rates are rising instead of falling. Long-term rates are rising instead of falling as they usually have done. So you can turn a pretty bad recession and a pretty severe market correction into an absolute wipeout, 50 to 80%.
What do you make of the environment that we're in right now? There's an incredible amount of people not paying their rent, not paying their mortgages. They can't. We've had the government pull this back out even further. We've had talks of quote unquote infrastructure, global corporate tax. What's going on, Rick?
Well, I would describe my reaction as horrid fascination. The truth is, Hayek, many years ago, 60 or 70 years ago, described the circumstance in front of us and his fear of it by saying, we always need to remember that there's a lot of ruin left in a country as great as our own. So it isn't something where I expect the end of the world next week, but one needs to be concerned. One needs to be particularly concerned if one is your age or younger. What the real impact of government debt and deficits and the debasing of the currency is about is an older generation, which is to say my generation, which has voted themselves all kinds of cool benefits, enjoying the benefits and leaving the bill with your generation. The fact that we have consumed the great output of this society and our consumption has left you all with the bill is something that, were I your age, I would be concerned about and angry about. It's ironically sort of amusing to me that there seems to be overwhelming fondness among your generation for big government. I suspect that your generation is going to get what they want, good and hard, and they will enjoy it less when they understand what's in front of them. I'm reminded in the broader part of your description of a little poem that I learned when I was earlier. It goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. As a society, we are spending more money than we are creating. And we are financing that by mortgaging our, or in my case, rather, your future. And this situation goes on as long as there is confidence in the system. But when confidence in the system exits, or I should say, if confidence in the system exits, then the consequences are certainly unpredictable, but almost as certainly, Jake, unpleasant. I would suspect that the calm that we're experiencing in political and financial markets is due to the fact that many people don't understand the difference between liquidity, which we have lots of, which is to say money in the system, and solvency, which is to say that we have the ability to service our debts and repay our debts, which we don't. And I suspect at some point in time in the future, perhaps sooner rather than later, we're going to confront that. How we confront it is something that I don't know.
So you mentioned Hayek. He wrote the book Road to Serfdom, right?
Yes.
How much of that do you think is playing out right now?
I think it has been an ongoing process. I think that all investors, but particularly young investors, would do themselves a service by reading both Hayek and von Mises, and probably starting actually with Hayek Light. Read Henry Hazlitt, Economics in One Lesson. It's important to understand the way the economy really works, rather than the way that your university or your congressman or somebody like that believes it should work. So I would suggest that rather than starting with Hayek, who is a pretty pedantic writer, that younger people start with Economics in One Lesson by Hazlitt. And that will give people of any age that aren't familiar with it a very good grounding in what is going wrong and what one might do to ensure one's self against the outcome.
So can I ask you, especially when you worked at Sprott, I mean, you probably kept you never said too much in an interview, but you also are more optimistic than Doug Casey is too, right? Than one of your good friends and someone I really love to talk to that you connected me with. But I can't help but to think that Doug's painted picture of the future, we seem to be moving more in that direction. When you have a country that is the largest debtor nation in the history of the world, and you have an even worsening gap between the rich and the poor, you have officials talking about a global tax, which is, I mean, what at that point, is it just our country's just a facade and you have a one world government system? I mean, you're moving into this territory where you said as a young person, you should be concerned. I just can't see how there's a bright picture in eventually, even if something bad happens, maybe something good will come on the other side. But that road to serfdom seems like a real possibility. And I want to know your thoughts on it. And then I want to know the best advice you have to not walk down the road to serfdom.
Those are big questions. So let's unpack them one at a time. The truth is, as you say, compared to Doug, I'm a hot-eyed moderate. I always like appearing on panels with Doug because he makes me seem absolutely reasonable, which I seldom am. Understand that Doug has been right with distressing regularity, and the outlook that he espouses, one would prefer him to be wrong rather than right. I am personally an incurable optimist if I get to look far enough in the future. We've discussed the reasons for this on your show, but we'll do them again. The younger generation, far from being the wastrels that is suggested by my generation, are the most empowered and educated generation that the world has ever seen. You don't even have to have access to facts anymore because Google has all of those. You don't have to have access to knowledge. You just have to have access to how to get hold of knowledge. And information isn't distributed from the top. Young people wisely don't always listen to what their government has to say. There's peer-to-peer information distribution, including a very smart young guy named Jake Ducey, all of which is very, very good. Further, for everything that's wrong with the United States, it's still a place where 5 or 6 kids can get together, commandeer a garage in Sunnyvale, California, and out pops Google, which makes $20 billion a year, consuming almost no capital in the process. All of that's good. So my optimism is founded on the fact that through individual initiative and intelligence, thus far at least, we have been able to afford our collective stupidity. Now, it is true that the weight of our collective stupidity is beginning to slow down our individual initiative. And my belief is that there is probably a reckoning due. When you discuss the debt and deficits, however, Jake, this is a correctable problem. Remember that the on-balance sheet liabilities of the US federal government are about equal with GDP. If we could restrain the growth of the on-balance sheet liabilities to a level less than our economic growth, the truth is that the government has a way out. The off-balance sheet liabilities are much more concerning, but much more correctable. The right thing to have happen is that when the younger voters outnumber the older voters, they say to us, that is, your generation says to my generation, you know all those promises you made yourself? Social Security, Medicare, Medicaid, all these trust funds? You made the promises. You keep them. You pay for them. We're not gonna. a good old-fashioned default where the younger generation of voters says to the older generation of voters, you lied to yourself. I didn't lie to you. You keep the promise because I'm not going to. Now, this would be politically interesting in a country like the United States, where older people like myself believe, because they've made themselves the promise popularly, that they have the right to stiff your generation with the bill. But a good old-fashioned default, which is to say the renunciation of the generation that got the obligation without getting the benefit, would solve the problem very, very, very quickly, albeit there would be an awful lot of social and political chaos. My friend Doug Casey describes that process by way of saying, I really want to see this happen from far away on a broad screen TV. He doesn't want to be part of it. And I don't suspect that that's what's going to happen, actually. But the truth is, it is a very correctable circumstance if you had the political will to correct it.
Yeah, I think I'm. It sounds like, as you and I were talking off air, I'm more in Doug's camp. I'll watch it from far away on a television. Is kind of the way that I'm moving. What do you suspect will happen then?
I suspect that we'll muddle through. I suspect that, first of all, confidence will begin to subside. And I suspect there will be one or more financial events, not unlike 2008. I guess that's the good news. I suspect that your generation will begin to push back against unfunded liabilities and against debt and deficits, as your generation, which, as I say, is the most informed generation that has ever inhabited the earth, comes to understand that government, far from being their friend, is their mortal enemy. And my hope is that your generation has the courage and the sense to do what my generation didn't do. And I sort of suspect that that's what's going to happen over 20 years. It's getting from here to there that has me concerned. Given that I'm 68, 20 years, 25 years seems like a reasonable time frame of concern for me. But, I also think that when you are confronted with societal issues that are bigger than you, that your first obligation is to take care of you and yours. I'm not advocating being selfish necessarily. I'm just suggesting that if 370 million Americans took care of themselves, nobody would have to take care of each other, and we wouldn't have any problems whatsoever. Given that you can't control what other people propose to do to you, I think you need to take affairs, to the extent that you can, into your own hands, which is to say, in particular, people of your generation need to begin to do something they haven't been taught to do, which is save and invest. People need, in particular, to invest in their education. I'm not talking about the education that they might get from New York University or Cal Berkeley, but rather reading the great books, coming to understand Human Action by von Mises, coming to understand the investment process and the savings process. I think it's very important that people begin to become self-aware, and to the extent that they can, self-sufficient, both intellectually and financially. And I think that's becoming critical.